You know, every business, whether it's a tiny startup or a global giant, eventually hits a point where it has to make a big purchase. We're talking a new piece of equipment, a fleet of vehicles, maybe even a game-changing patent. But how do you actually account for those huge investments? Well, let's break it down.
So let me introduce you to Liam. He's just finished his MBA, and he's got this awesome idea for a business that's, believe it or not, already taken off. He's silk screening these super cool designs onto workout clothes, and his pop-up shops on campus, they're selling out like crazy. But with that early success comes some pretty big decisions.
And here it is, the first major crossroads. To really scale up his business, he's thinking about buying his own professional silk screening machine. Now this is a serious investment, something that's going to help him make money for years and years. The big question is, how in the world does he account for a purchase like this?
Okay, so before we even start talking numbers, we have to back up and ask a really basic question. From an accounting point of view, what is this machine? And that brings us to a really core concept, the difference between tangible and intangible assets.
Honestly, it's pretty much what it sounds like. Tangible assets are the physical things you can actually touch. You know, a machine, an office building, a delivery van. Intangible assets, on the other hand, are the things you can't touch, but are still incredibly valuable. Think about a brand's logo, a secret recipe, or a famous patent.
So it's pretty clear Liam's new machine is a classic, long-term, tangible asset, right? He can touch it, he's planning to use it for way more than a year, and he's not buying it to resell it, he's buying it to be the engine of his business, to generate revenue.
Now, let's just quickly look at the other side of the coin, those intangibles. You've got things like patents for inventions, trademarks for brand names. These don't have any physical form, but wow, they provide critical legal protections, sometimes for decades, or in the case of a copyright, even longer than a lifetime.
Okay, so we've nailed it down. Liam's machine is a tangible asset. So what's the next logical step? Well, how does he actually record this thing in his company's books?
And this is such a critical question. The machine costs $5,000. So can Liam just treat that like he would an electricity bill, write it off as a business expense for this year, and just call it a day? The short answer is a big no. And the reason why is totally fundamental to good accounting.
He has to capitalize it. Now, that sounds like a complicated word, but it's actually a pretty simple idea. Instead of taking the entire $5,000 hit in 1 year, you record the machine as an asset on your balance sheet, and then you spread that cost out over all the years you'll actually be using it.
And get this, capitalizing isn't just about the sticker price. You have to include every single cost it took to get that asset up and running. We're talking shipping fees, sales tax, installation costs, all of that gets bundled together to become the asset's total value on the books.
So why on earth do we go through all this trouble? Well, it all boils down to something called the matching principle. And the logic is really elegant. Since Liam's machine is going to help him make money for, say, 5 years, you should match a piece of its cost against the money it helps make in each of those 5 years. It just gives you a much truer picture of how profitable the business really is.
And make no mistake, these are not just friendly suggestions. Getting this stuff wrong can be an absolute catastrophe. Back in 2002, the telecom giant WorldCom committed massive fraud by capitalizing costs that they should have expensed. Why? To make their profits look way better than they were. It led to one of the biggest corporate scandals in U.S. history. So yeah, these rules exist for a very good reason, to make sure the numbers tell the truth. So, we've decided to capitalize the asset. But how do we actually do that whole spreading the cost out part we talked about? Well, that is where we get to what some people call the magic of depreciation. Depreciation is basically the official accounting process for turning that asset cost into a yearly expense. Now, this is really important. It's not about what the machine is actually worth on the open market. It has nothing to do with its resale value. It's just a systematic, logical way to account for the value of the machine being used up over time.
And Liam actually has some choices here. The most common way to do it is the straight line method. It's simple, it's consistent. But what if his production goes up and down a lot? He might choose the units of production method to better match his costs with his output. Or if he thinks the machine is going to be most valuable right at the beginning, he could use an accelerated method to take a bigger expense hit up front. And believe me, the method you choose has a huge impact on your books, especially in that first year. Just look at the difference here. With the straight line method, his expense is $1,800, but with the double declining method, it skyrockets to $4,000. That can totally change how much profit he reports for the year.
All right,
So we've spent a lot of time on Liam's tangible machine. But what about those intangible assets we talked about earlier? You know, the ones you can't touch? How do we account for their value over time?
Well, the process for spreading out an intangible assets cost is almost exactly the same as depreciation. It just has a different name: amortization. Seriously, you can just think of it as depreciation for things you can't touch. The whole idea of spreading the cost over its useful life is exactly the same.
Now, one of the most interesting intangibles out there is something called goodwill. This little line item only shows up on the books when one company buys another. It's basically the extra money, the premium, you pay above and beyond the value of all the company's individual assets. It's the price you pay for their great reputation, their amazing team, and their loyal customers.
Okay, take a look at this number. That's $5.7 billion. What in the world could that possibly be? It's not a company's revenue, it's not their profit, it's the value of an intangible asset.
That massive number, that was the value of goodwill sitting on Apple's balance sheet back in 2017, and it was created entirely because they had acquired other companies. It's a perfect example of just how much a company's invisible qualities, its brand, its reputation, can be worth in real dollars.
All right, let's fast forward. We've reached the final chapter on our asset story. Years have gone by, Liam's business is booming, and he's ready to upgrade his equipment. So what happens when he finally sells that old machine?
The accounting for this is actually pretty straightforward. First, you figure out the asset's book value. You just take its original total cost and subtract all the depreciation you've recorded over the years. Then, you compare that book value to what you sold it for. If you sold it for more, you record a gain. If you sold it for less, you record a loss. Simple as that.
So, you see, from the second you buy it, through all the years you use it, right up to the final sale, every major asset tells a story on the balance sheet. Accounting isn't just a boring set of rules, it's the language that lets you read that story and really understand the journey of a business. So take a look at your own business, or maybe a company you admire, and ask yourself, what story are its assets telling?